An auditor went through all TPUSA's documents and uncovered a massive split dollar life insurance policy that was taken out on Charlie Kirk in 2023 with yearly $350,000 premiums. We're going to be reacting to all this information, breaking down what a policy like this could look like, what it would pay out, and the mechanisms behind it with this type of life insurance policy.
An auditor named Brian Ferentz went through all of TPUSA's tax documents and found that in just 2023, a large life insurance policy was taken out on Charlie Kirk. As you can see here, GGLF LLC paid for a split dollar life insurance policy for the president/CEO of Turning Point USA, aka Charlie Kirk. Annual premiums for this policy are massive, $350,000 per year, meaning that the death benefit for someone who is 31 years old and a non-smoker would be between $20 and $50 million. All of this information is public because TPUSA is a registered 501c3 nonprofit, so you can go ahead and look up this information for yourself. GGLF 2023 LLC is also owned by Charlie Kirk, so why would he have one business paying one of his other businesses for his own life insurance policy? Because it's a common tax strategy for high net worth individuals that comes with massive write-offs and deductions, making sure that the beneficiary would not have to pay a massive estate tax of up to 40%, meaning on a $10 million death benefit policy, that could trigger a $4 million tax bill. Remember, in this case, the payout is supposed to be a lot bigger than that. The timing of taking out such a large policy so close to the date he was executed is interesting, considering this was far past the time that he had nationally broken out and become a huge public figure with TPUSA. It could, of course, be because he got married and had 2 children and wanted to make sure that they were protected in case anything happened. But that's making an assumption that we know who received this money. Even though this tax information is public, how much the policy paid out and who the beneficiary is private. Now, one would assume it's Erica Kirk, but if it was somebody else, that would be quite interesting. As always, I want to hear what you think about all of this down below.
Obviously, Dom, I just want to say this first and foremost. I know that Charlie Kirk's passing, he's like a lightning rod. I posted something about it on all platforms, and I got a lot of people that loved it. I had a lot of people that unfollowed me or, weren't happy that I used his name. And then obviously after the fact, there's been a lot of people that have different opinions about how things are being run there. We're a life insurance channel, and we're obviously running a podcast that's going to talk about the life insurance aspects. That's what we're going to try to stick to. But we know that with this topic, it's gonna get different viewers probably. And so I just want to acknowledge that and know that Charlie, we hope you rest in peace, and we hope that this episode is helpful, beneficial, and I think breaking down what is split dollars. We even have, from an insurance standpoint, Dom, I know you've run some numbers with just one company, so we have no idea what company he worked with, but it gives you kind of a baseline of what type of death benefit you could be expecting. And so with that, Dom, I think it would be helpful if you unpacked like what even this policy, how it works, and like how what is, like, if someone doesn't know anything about split dollar, and is it weird that LLCs are making payments? I think it'd be helpful to, like, first of all, break down like how this even works and kind of the moving pieces.
Yeah, and I think that for this video, there will be 2 separate pieces of it that I think that the audience would love to know, right? Obviously, I think starting with what you just asked for is going to be a very good part. And I do think it'd just be fun to just hear your perspective specifically. I'm not very big into politics. I actually don't watch a ton of news at all. I don't know anything that's going on with, his wife or anything along those lines, but I know you're more into that just from a standpoint of like keeping up with the news, and be very curious to know from a quote unquote conspiracy, the ideation, if this was going good timing, whatnot, what this kind of looked like. But I do think that starting off with the ideation of, not even the ideation of like, what is split dollar and what she was saying specifically, because I do think that as it does sound complex with what she was saying, looking at tax documents, I think it's very simple in practice, but I think it's for a very few. Okay, so I want us to start off with that, is that this is for the very 0.001% of people. And there are many different type of split dollar strategies. We even have a video with Alden, who is one of our top wealth coaches, who has a split dollar video on generational planning. I want to be very clear that just because the name split dollar is in it, that is a very different strategy than the strategy that we're talking about here today. One is for passing down wealth from generation to generation, and then one is from paying an executive essentially some type of bonus or compensation. And the bonus and compensation is the conversation that we're having today around like the split dollar conversation. And so we've actually even done other videos. I did one probably almost a year ago now, where we did one on Jim Harbaugh, where we talked about the Michigan, when he was a coach at Michigan, and Michigan paid him a compensation of, I think it was around like $2 million per year as part of his compensation package to be a coach at the university. And so long story short, split dollar really is just like a cost sharing arrangement between a company and an executive. Like that's like as simple as it is. You got two parties. You have a company and then you have an individual. It's usually an executive. And so that company will essentially agree in the form of a loan. And the reason why it's in a form of a loan is that there's tax benefits around that to pay compensation to that executive. And by doing so, the executive gets this life insurance policy. There's cash value, there's death benefit. And when that executive dies and passes away, the death benefit portion of it. So let's just pretend in this example, right? $350,000 was paid to Charlie Kirk, right? Per year into a life insurance policy. He died this year, 2020. So let's just say it's 3 years-ish roughly.
Yeah, two years. Like, let's say 2 years.
Okay. Yeah. So $750,000 of premium was essentially paid into this policy. Let's just pretend that it was a $10 million death benefit. Well, of that 10 million, $750,000 would get subtracted from that 10 million and get paid back to the company that paid for the life insurance policy. And then Charlie Kirk's beneficiaries would just receive the rest of the death benefit. And so the portion of that would be responsible for Charlie Kirk, because it is a split arrangement, so there is a part that he has to be responsible for, is essentially the interest that is being accrued and calculated on the $350,000 per year. And usually the loan interest is so much cheaper than it is when it comes to like a bank. There's just IRS guidelines of like bare minimum percentages that you have to do, and it varies per time frame when you're doing it. And there's actually two different types of split dollar arrangements that you can do. You can do a loan regime that we're talking about right now, and that's actually the most common, which is the practice that we did. And then there's the economic regime as well, and that one's a little bit more complex. I think but it's rarely used, especially right now and today. And so just when we're talking about this right now, you don't even really need to know like the differences between loan regime, economic. Like I think that's out there for most financial planners, advisors, et cetera. The biggest thing that you have to just know is it's between two people, a business and executive. The business will pay a life insurance premium for this individual, and they get this massive death benefit. They could utilize the cash value as well, but a portion of that will be held as collateral. So when they do die, pass away, they can essentially get paid back. So it's a great way to keep your employees. You can call it golden handcuffs. You can call it, you can call it many different strategies. There's lots of really creative ways that you can use life insurance to, or use loans to essentially create life insurance policies. Even we've talked about premium finance in the channel before. So it's all kind of ties back into the idea of extremely wealthy individuals using a strategy to save dollars for themselves to get a massive death benefit to pay out to them and their family when the time is right.
Yeah. Tom, I think that was well said. And it's from a strategy standpoint, it's very strategic when it comes to company. And we don't really know a ton about the beneficiaries or anything. And so there's a world where there could be multiple beneficiaries. It might not just be the family. And I think the assumption is that the net death benefit would get paid income tax free to the family, but that's just an assumption. There's a world where some of this could be a potential key man concept if a portion of the death benefit could go back to Turning Point. Again, maybe I'm way out of line here, but there's when it comes to life insurance, there's a lot of different aspects, and not that I've seen it. I haven't seen anything about a key person in policy, but that would have been another thing that if Turning Point wanted to do, like there's a world where they might be able to benefit from a passing of a key executive, which if that's the case, imagine all the more conspiracies that would go out there. Is like if Turning Point was if they were getting a bunch of money, like that would just, I think, fuel more conversations. But just to be clear, I don't think we know with unless someone leaks us the company and the details, we don't know the full parties other than what's documented from a tax perspective. And the person that said, like in this video, that said like, well, why didn't he have this sooner? I just want to commend him for getting it in general, because this is like an advanced strategy. And it's one of those things where, yeah, he probably should have done it a few years sooner, but there are people that we run into that are making a lot more money, maybe not as influential, because I really do believe Charlie was going to be president if he stayed alive, kind of deal. But from a wealth standpoint, and they haven't even done this type of planning. So it just tells you, like, Charlie, from a financial standpoint, to have the insight to do this was great. But the question is, who got how do the economics work? And so anything that you want to add to what I shared, but I really do appreciate you breaking this down. And it's obviously, it's a strategy that if you're doing really well, or if you're like a key executive of a company that's doing really well, this is a strategy that you should consider, or at least think about when it comes to being compensated.
Yeah. And before we actually look at an illustration and pull up a theoreticalization of what could have been, I think us not knowing who the beneficiaries are is a prime example of why someone may want a life insurance policy, right? Because now you don't have to go through all this. You just have speculation, right? Yes. It's private. People just assume, and it's not there for public of hey, this is what's happening, and that could cause way more chaos. Imagine if there was something that happened that was that shouldn't have went to, or people shouldn't have agreed with, or all of it didn't go. It would just cause so much more chaos for him, his family, etc. And so I think that this is just another reason why the privatization of it is actually a good thing. And to the point, I think that she actually shared it in her video. He got married in 2021 and kids in 2022 and 2024. That's actually not that far away from when he would actually even start thinking about real life insurance. Because outside of that, you're just trying to think about why would I even want a life insurance policy unless somebody really talks to you about the benefits of the cash value usage while you're alive, which, income, for a compensation perspective could obviously be a motive. But usually if there's no death benefit incentive, then there's a high likelihood that someone's not going to be yeah, this is an exciting strategy to put in, hundreds of thousands of dollars and have tens of millions of death benefit for who, right? So.
Yeah, most people will do this as a retirement supplement or some other benefit. The fact that there's a massive death benefit that's tied to it is just a cherry on top. I will also say this, and this is again, this is alleged, but because we're in the space of the insurance space, we meet lots of people, we connect with lots of people, and I know people that have had conversations with Charlie and Charlie's team, and I think it's very, very fair to say that this was not his only life insurance policy that he had. I'm very confident in that. So just because this is the thing that we're seeing from, that had to be disclosed from a tax perspective, most life insurance is totally private, and there would be no way to know unless someone leaked it, unless someone shared it. Because it's totally private. And I know of a couple conversations of people that talked to Charlie very early on about insurance. And so there's a very good likelihood that this was just one policy that we know, but there were other policies, which that again would be, there would be two things that would be a challenge. Number one is, when you're Charlie Kirk, how much life insurance can you actually get? Because it's can you get $100 million worth of life insurance? You're young, you're running one of the most fastest growing organizations out there. There's your track on you being the president of the United States. You're running this massive organization, but like that, even at, you have to ask questions around like, how did someone like him, like you, because you can't be worth more dead than alive kind of deal. And so there'd have to be some type of economic justification for how much death benefit people would insure. And so like that would be like, obviously hindsight's 2020. I would just be really curious like how that happened, because Charlie wasn't crazy public about his private dealings when it comes to the money and all, because I know that he did really, really well financially in addition to running a very successful organization. And so that's one thing. And then I guess the other thing is we just don't know where that money is going.
Yeah. I think it's safe to say what you just shared is that there's too many unknowns to know fully. All we can do is just pull the pieces together, share the evidence, share the news, and give our perspective, right?
If you know details and you want to reach out, we're lines open. The line's open, and we will keep you anonymous if you want to be anonymous. So we'll just say that.
Amazing. Be more than happy for that. All right. So what I'm going to do now is I'm going to just share two different illustrations that in theory could have somewhat of an ideation around what the numbers could look like. So that way we can validate even maybe some of the numbers that she talked about from a death benefit perspective. And it's hard to know how the policy was designed, what the base PA ratio was, 100% base, was it all designed how we would design it for somebody? Like, we don't know, right? So that's why I designed two different ones on both extremes, and just to give us somewhat of an ideation around it. And so with that being shared, let's go ahead and look at the first one. Okay. So Caleb, can you see this well? Do I need to make it bigger? Or are you good from your view?
I can see it.
Perfect. Okay. So $350,000 again was paid from company to Charlie, right? So the company would essentially say, all right, we're going to take $350,000 out of our pockets and pay it to X insurance company, right? So every year, he's age 31, he's going to have $350,000 that is going into the policy. You can see the total amount that's getting paid into it. So like we talked about early on, if there was only 2 years of payments, then there was $700,000 that was actually paid into this policy. We have a total cash value column. Okay. So this is actual dollars that Charlie in theory could have utilized and used if there was some type of usage for it, but it would have to be within certain parameters. There's a certain amount of death benefit that always has to be collateralized no matter what happens. But early on, it's not necessarily something that we need to be worried about, because you can see that how large the actual death benefit is versus the amount of dollars that's actually going in is very little, right? The longer you pay into this, how life insurance works, your death benefit and cash value equal each other. But early on, you pay little dollars relative to the amount of death benefit that you'll eventually have right away. And so you can see that there was about $10 million of death benefit that was into this policy right away, year one. So when she said, I think she said $20 to $50 million, I think is what it said. But then there was like another article that said there was about 10 million. So she was speculating as well. And so I would say that based off of what she was researching, it's relatively close. Just from the standpoint of like, if he actually died and passed away in year 2, and it was designed for high early optimal cash value, which I doubt that it actually was, but you never know. I mean, he's working with certain specialists. Just we have seen so many policies that are not designed that way. Then it would be close to about $11 million when he passed that was paid out to the beneficiaries. And I say beneficiaries as in 700,000 minus 11 million would go to his beneficiary, and then the other $700,000 of this would get paid back to the company that was essentially paying the premiums. This policy is very, from a cash value perspective, is very sexy and attractive. Like it's, you start to look at the amount of cash value and contributions. So year 5, you put in 1.75 and you actually have more back than it. And so it's just like a very attractive, higher cash value policy. So don't need to go into too many more details, over complications around it. In theory, what would happen is like you see year 10, usually these things only last for about 10 years or so. They could even be shorter, maybe 7 years. When you have these types of policies and you're paying large lump sum money like this, like they're not paying it more than 10 years in most scenarios, but
Mhm.
you never know. We obviously don't have the balance sheet of every single transaction that's happening when it comes to split dollar, but these would normally be $0 that would be, either reduced paid up or premium offset. And I'll kind of look at that in another example. So, Caleb, any questions, any thoughts you
No,
want to share with this before
this
we?
is like high early cash value style. And we're talking 10 million on the front end. You're validating that, and there's a good likelihood that it's not designed this way, and it's somewhere in between the next one that you're going to show, which I would imagine is going to be a lot higher death benefit, a lot lower cash value.
And let's pull it up and look. So we have, instead of $10 million, that's right off the rift. And I like it here that we can actually compare the total death benefit right away. We actually have 29 million. So you can see that that's a pretty massive difference just in regards to total write-off. I'm going to move this over slightly and pull this back up. So there's a $20 million difference. When we start looking at the total cash value though, right, we show that there was like probably 80-ish%. It's like 200 and something $1,000 of cash value versus zero. And so, I mean, there's a high likelihood that Charlie didn't need the money for anything, right? I mean, he obviously was a very wealthy individual. But at the end of the day, like having some cash value for compensation later on in quote unquote retirement, that's what this is also deemed as from an attractive perspective too. So it really would just come down to Charlie's like goals, what he's trying to accomplish, where he's at in life, the way he views his future. Like there's so many conversations that would need to be had with him on like what he really wants. And the goal of this is not to necessarily discuss that, but it's just essentially to show that the cash value differences versus the death benefit differences, and there's roughly around $30 million, which is still close to her number that she was sharing of like, 20 to 50 million. It's still in that ballpark roughly.
Well, and that's for those out there that are looking into the different angles of what actually happened. This would be interesting because it would be like, whose idea was the insurance policy? How was it designed? Was it designed mainly for death benefit and legacy and estate planning? Or is it designed mainly for cash value? That would be interesting in itself. Like I think that would be an interesting fact to know. And there's probably a combo of both. But looking at the policy itself, you can decide or see what the motivation was.
Yeah, no, for sure. Which kind of goes into the next phase of this. Like, I am genuinely curious, Caleb, your perspective on like the whole thing from a conspiracy theory ideation around.
Get me in
like,
trouble.
Exactly. Get you canceled. That's kind of the whole point. If you get canceled, we're doing good things.
Yeah, I admired Charlie. I didn't agree with all the things that he said, but I admired his ability to communicate. I admired his ability to dialogue, and I thought he was really sharp. He was very strong for Trump, and I'm not anti-Trump. I just, I admire people that can look at both sides, very similar to what we're trying to do. Like, hey, this is what I love about Trump. Here's not what I love. And so he was like very in. So that was like the only reason, if I'm being totally honest, why I didn't follow him more. But like from a human standpoint, I even went to Turning Point America Fest a couple of years back, and it's really impressive, the festival and event that they put on. Obviously, his passing was tragic, and from a freedom of speech standpoint, really important that freedom of speech is a thing, regardless if you like him, not. I think people should be willing to say whatever they want to say about him, and they shouldn't be canceled, and vice versa. So, I hope his message continues to go on. I hope people continue to have more dialogue. So since passing, I think there was like 2 weeks of like everyone is just like gutted, devastated. Yeah, obviously, if you were a fan, if you weren't, I think there was still, even the people that weren't a fan like that, I think there was a part of unity that came together to be like, hey guys, no matter what your opinions, like this can't happen. We can't be having people murdered and executed in front of that. And then, but there's been a lot of speculation since around some of the like weird behaviors that Turning Point USA's had, his wife Erica Kirk, and it's interesting. I obviously we're running a business, we're doing other things, we're making our own content, so I don't get to follow everything, but it's definitely there's a lot of questions. There's a lot of question marks. He was involved in a lot of things. Very, very powerful people. He was starting to ask some very interesting questions that may have been not very convenient to all parties. You like how political I'm getting? I'm just like, but like he was starting to poke the hornet's nest a little bit, and he just happened to die soon after that. That's interesting. And there's been question marks about the ethics of certain things. Was Turning Point doing things ethically? Were there yada yada yada? So all that to say, I as a freedom of speech person, I think speech is good from a standpoint of like I'm a fan of people, challenging and uncovering things, but unfortunately, it can get the end result can be like Charlie's message, whether you agreed with it or not, is getting tainted by these other things. And it is what it is. Like it's not like people aren't going to stop if they believe that there's some shady stuff going on. They're going to continue to pursue that, and they should. But it's like this. If Charlie was here, I would be really curious to hear, like if he was looking down and being like, okay, I know all the details. I think he could save. I think he could save a lot of people a lot of time. So that's my take. I think this insurance policy is very interesting because it kind of like makes people ask, what's actually going on? Like, who is behind this? Could this be a motive? I'm telling you right now, if you think $30 to $50 million was the reason, I can tell you it wasn't. Charlie's on track to being the most powerful person and influential person in politics. So could it be a part? Maybe, but I wouldn't see this as a motive because he's worth a lot more alive from depending on how you think about it. So from an insurance person, from a financial person, I don't think that there's any smoking gun here. I just think it's an interest. I just want to know more. And I'm just curious from like how his whole financial situation was set up. So for what it's worth, I think Erica will be just fine financially, but obviously she's got other things that she's going through, and she's got to really figure out her PR strategy because it seems like the more she talks, the more just confusion happens. And so but I also think it's hard to be in a world where every time you open up your mouth, you're getting analyzed from 100 different angles. So I don't envy her at all. But that will be interesting. So that's my take on the whole thing, and it'll be interesting to see what comes.
Okay, so the first Q&A question, we have our head of media that decided to give us one of the longest Q&A questions of all time. And so he's going to put that up on the screen, and I'm actually not going to read it because trying to read it out loud, we've already tried it a couple times. It's hard to fully
you're
say
being
it.
I tried to read it out loud and failed miserably. So we switched it to Dom.
Amazing. So there's essentially two parts to this question. Okay. So the first part of the question is essentially saying, is it possible to do a small policy, $25,000 or $50,000? Okay. So let's just start with that. And usually when I talk to people that don't know about the strategy, when they mention $25,000 or $50,000, they're talking about the death benefit. And so I'd have to get clarity on what it is that you meant. Because if you're doing $25,000 or $50,000 from a contribution perspective, that's a great policy. That's something that could be very beneficial, could produce cash value that allows you to borrow against and use, which is part of some of the second question that you asked. But if it's a $25,000 or $50,000 policy from a death benefit, especially for a grown adult, it's just not a policy that would make a lot of sense.
Yeah, the way I read this, Dom, is we're talking more trust and all like Rockefeller strategy, and he's wondering if $25,000 to $50,000 policy would be too small when it comes to like that structure. But that's maybe why I got mixed up, because it could be the death benefit that he's referencing.
Okay. Yeah. I mean, I think that's sometimes the hard part about the Q&A for us to know fully, right? But last thing is just, let's just pretend it was a death benefit first, and then we'll assume that it's the cash value piece as we go into the next phase of it. If it was a death benefit, it would be more of like a final expense policy to cover like burial and other things like that, which doesn't necessarily make sense for the question that you'd be asking from a trust perspective. And so when we're just talking about the trust perspective, we do have other videos around this, and maybe our media producer can essentially like put it in somewhere, which essentially like we call it the Rockefeller method or the waterfall waterfall method. But if you have a $25,000 or a $50,000 policy, or it looks like you even say $100,000 policy here, and you're paying that on an annual basis, yeah, creating a contract to be able to have the parameters around from one generation to the next, where if one person dies and passes, it essentially gets replenished back to the trust to borrow against, to use for other activities from the trust, essentially being the owner. There are things that you can do. Like, it's just simply, the answer is yes, you can do that. I'm even reading between the lines of what it is that you're asking, where it says, have it where if you die, the insurance policy will be paid out to the trust based on the contract. Like, that's essentially what the contract essentially states and says. When you die, the death benefit will get paid back to it. And so, simple answer, I think you should watch that video because there's way too much to explain from us to understand that concept. But this is definitely possible. And as long as you're doing enough contributions, $25,000 to $80,000 a year, we think that the strategy could make a lot of sense and it is possible. If there's something in there that I misspoke on because you asked it a different way, I apologize, but we did our best.
Yeah, I'd also say this. This is what I would also say to a question similar. If someone's like watching the Rockefeller method and figuring out like how little you can do, don't do the strategy. Just own the life insurance in your own name and try to do estate planning where the death benefit gets paid to a living trust or something where you can figure that out. Having trust owned policies and all sounds really good, but it can get really complicated. And unless you are really wealthy, it might not make sense just from like the time and energy and money that it goes to set up all those things. So I think that's the idea of the Rockefeller method. You can use that waterfall method regardless if you use like crazy irrevocable trusts that own the policies. Like, it's just the idea of like flowing money to the next generation and how that gets set up. And a mistake I see people making is almost overcomplicating it a little too soon, and they actually end up losing more in the long run because they're trying to do the right thing, but they're getting way too complicated and cute early on. So I don't know if that resonates, but that'd be my 2 cents when it comes to that. The next question is, could you guys make a video on how to split policies across your family versus a single policy on yourself? How much coverage does it make sense for a stay-at-home mom versus working spouse? I haven't seen anyone cover this topic. I think that's a great question, Dom. That's a great question. Here's how I would say it on a Q&A standpoint, and then maybe we make an actual video breaking this down. But when we think about economic value, whether you have a stay-at-home mom and a working spouse, both have economic value because one is staying at home, it allows the other person to work. So insurance companies very much see both of those. So like, you could be a stay-at-home mom, you could be married to someone who is making really good money, and they'll take your household income and allow you to get life insurance based on that because it's a team effort. So I think first and foremost, it's just important to understand like how much coverage could you get, and you might be surprised how much money you could get insured as being a stay-at-home mom as if you're married, because they very much look at household, and there's a lot of things you can do from just a cover letter. And so very, very pro like working as a team. So that's the first and foremost that I would say. Then the second thing is when it comes to strategy, household, you want to figure out, okay, where do we begin? I think you begin by covering your economic value, which is another way of saying like insure as much as you can, whether that's just term insurance or some permanent insurance, and try to get that both on the stay-at-home mom and the working spouse, and so then you lock that in. And then the question comes in, okay, if I have extra money that I want to fund to max fund a life insurance policy for all the other benefits of permanent life insurance, how would we go about that? Should we split 50-50 or should we go on one or the other? And the safe political, free answer would be like split 50-50 because you never know what's going to happen. You look at divorce rates, blah, 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 blah. And so it's clean if you split 50-50. From an efficiency standpoint, if we were looking just at an efficiency standpoint, it could make a lot of sense to just go a permanent policy on one of the spouses. And if you want it from a cash efficiency standpoint, the female is most likely going to have a better performing policy than the working the male kind of deal. So that could be one thing that we look at. But ironically, we tend to put more life insurance on the person that's working, because the idea from a risk management standpoint is, hey, yeah, we both are equal, but if I die and I'm bringing in a salary, that's a more immediate. So I want to make sure that we have coverage. So first thing is we want to make sure both are covered. Second thing is, where does it make sense to get the extra permanent policy? In a lot of cases, we're getting the permanent policy on one life, and then we have convertible term on both, and then we can convert in chunks. That's what we did with my family, like my wife and my sit up is that way, and that's what we would recommend. And then when it comes to kids, I recommend getting life insurance, maxing out your life insurance on the parent level before you start getting conversations about the kids. That's like best case scenario, even if you're thinking about your family, because you're thinking about money passing down. And so that's, some people want to put life insurance on their kids and they have nothing. And it's like, number one, you can't do that if your kids are under 18. And number two, financially, that's not as logical either. So I would love to hear your perspective on my answer.
Yeah, no, I thought your perspective was great. And I think that's the best part about financial planning in general, is there's more than one way to skin a cat. And I think asking you personally some of the hard questions on what you value is where you would actually start, because as me, as a man, for myself, I'm going to personally start with maxing out as much protection on myself first and foremost, right? Some people may not agree with that, right? But for me, when I die and pass away, I want to make sure that my family is taken care of completely, versus, well, let me have a little bit less on me and then have some on my family. And then if something happens to them, then I obviously recoup. I feel better sleeping at night knowing that I'm taking care of that first and foremost.
Yeah.
Then after you have that in place, and you start to have maybe, and it also comes down to a cash flow perspective too, because if you max out yourself, but you have no more money, then you can't obviously get any more, on your, essentially the rest of the house. But I think starting with the term insurance on your spouse is a great place to start as you max out your side on their term and the permanent side, because then it's a very cheap thing. You can pay $30, $40, $50 a month to probably max out their side of the things while you've taken care of your side on the permanent on that side. Then once cash flow increases, then you can start, like Caleb, start converting that term insurance to permanent style stuff, and then keep increasing that as time goes on. Your income increases as well, which that is also a bucket of money that you can utilize and borrow against for other things. Then once you do that, then as cash flow continues to increase, then put it on kids, which has to be a permanent policy as well too. So that's kind of how I would go about it. It starts with values, then it looks at cash flow, and after cash flow, you start looking at what's possible.
Love it. Love it. Well, thank you so much for asking these questions. And we appreciate you just tuning in, and we look forward to reading the comments. I'm sure that we might get a few questions. And if you're new or you're even new to the whole life insurance space and you're just tuning in for the Charlie Kirk topic, please give us questions, especially when it comes to life insurance. We'll be in the comments answering them and looking at them. So thank you. And Dom, appreciate you a ton, man.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply.